For this video, we'll be having a look at Ubisoft, the French video game giant that is most well known for their franchises like Assassin's Creed or Far Cry, as well as some other names like For Honor, and I'm sure I'm forgetting a few famous ones, but I think the real big ones are Assassin's Creed and Far Cry. Now, when we look at their financials here in 2012, we can see that their revenue started at 1.2 billion, which has risen all the way to 2.1, which is an annual growth of 6%. So they're very much like increasing their revenue as time moves on. As they're increasing their titles, as they're able to expand their catalog, they're also very much increasing their revenue. So this is what we very much like to see. In 2020, 2021 was some pretty big years for them. I think it was COVID, everyone was at home anyway. Not much to do apart from playing games, so they definitely capitalized on that as well. Looking at their earnings though, their earnings have been growing from 400 to 1 billion here in 2021. Congratulations to Ubisoft for making their first billion euros in earnings. Overall, there's a 10% increase year over year, and as we always say on this channel, whenever we see earnings grow faster than revenue, it means that their margins are increasing. It means that they are becoming more efficient in running their business, or I think more accurately for Ubisoft, for a video game company, it means they have a broader catalog of games, so they have a steady increasing earnings and increasing revenue because of all the titles that they possess. Their intellectual property is very much increasing, which leads to an increase in revenue and earnings. So yeah, very good, very nice for Ubisoft to see this growth. Those are some very nice numbers. Looking at that depth level, the percentages at the bottom are quite scary, but this is mostly because that depth level was pretty much non-existent back in 2012, and it has risen all the way up to 2 billion here in 2021. Because you have to realize developing these games is a very costly enterprise. It's very pricey to do that, as well as for Ubisoft to keep running their servers, to keep buying their assets, to keep paying their employees. It's a very expensive and research and development heavy business that they're in. So they definitely need their cash on hand to actually keep on producing the newest Assassin's Creed, the newest Watch Dogs, the newest famous game that's going to make them money. So even though their debt has been growing, I think it's still very much within reasonable levels. Just a quick peek here shows me that's exactly 2 times their earnings, which is, it's fine. I mean, they're leveraging up, which is understandable, I think, if you want to make growth in the market. So I think this is fine. Looking at the excess cash as well, we can actually see that in 2021 they loaned a lot of money from the banks to try and bridge the COVID gap, which was going to be a bit more costly, I think, for most companies. And they just wanted to be prepared for anything that came their way. So it seems that they very much took out a loan in cash, but they just put that on not even like a checking balance, like it's actually like the actual excess cash that they have on hand that they don't have any use for right now. They're just stowing it away for a rainy day. So actually their cash can almost pretty much cover their debt, which is very much what we like to see. Looking at market cap, we can see it's a bit of a roller coaster by and large, starting up at 766 million, a peak of 7.8, 9.9 even in 2020, and it's been dropping down hard after this. I think their share price has come down a lot, which very much decreased their market cap. We'll have a look at that in a little bit. Still, their market cap has been growing by 24% annually, which is still a very high number. So kudos for them for giving nice returns for their shareholders. Enterprise value, this is the market cap, so the price on the market to which we add the debt and subtract the cash. Is the entire value of the business, and it's the value that we like to use, that I like to use as a value investor, to estimate just how risky a business can be and what their total value is. So we can see here it's mostly in line with their market cap. Of course, debt here influences a little bit, but it's mostly neutralized by the excess cash. So it's growing relatively in line with their market cap. EV/EBITDA ratio. How many years does it take for Ubisoft to basically pay for their entire company? Enterprise value. we can see in 2012 it just took them just over 1 year to pay themselves back, which is crazy. It's ridiculous. It was a very good buy back in 2012 as well. 2013, 2014, just over a one-time ratio. That is actually beyond me. But the ratios quickly started picking up from that. I think in the last 3 years, actually, like, it's skyrocketed. It started off at 1 times and moved all the way to 17 times in 2020. Now, I'm going to go ahead and say that's a little bit overpriced. Just going to be honest here. And we can see it came down drastically in 2021. It's coming back down to earth, more to like the usual level where it's been ranging at historically. The debt level, like I mentioned, it's they're leveraging up to actually produce these titles and to increase their catalog of games, but it's not at a level where I actually start to think it's a problem. Okay, so let's have a look at their cash flow statements. So looking at 2012, what we see here is that the cash flow from operations is 400 million euros, and it's risen pretty close to 1 billion here several years. 2018, 2020, 2021, it came down a little bit. So very much a 6% increase, which does mean that I think it's a bit shaky compared to earnings, because the earnings have been growing by 10%, their cash flow from operations has been growing by 6%. But this is because Ubisoft also does quite some financial investments on top of that as well, which very much influences their cash flow here. I also think that recently Tencent also took a pretty big stake in Ubisoft, because like right now Ubisoft may not be the most popular company for investors to look at, and most people are actually speculating that Ubisoft may be more of a takeover target than it is a proper investment. But we'll get to the reasoning behind that in a little bit, because up until now their financials have been looking pretty good, I have to say. So looking at the capital expenditure, now this is all the money that they have to put in to keep running their business. And these numbers seem very low, but I'm going to add a little caveat to this, because like this is only the money that it takes for them to keep running their facilities and keep running their servers. This is assuming that they don't put any money back into their research and development, that they don't actually work on producing new titles. This is really just the money that they need to keep running the business the way it is right now, with all their current titles, all their current servers, all their current offices. This is how much that takes. But of course, a gaming company, a video game company, they have to keep on producing the newest titles. They have to stay on top of their game, otherwise they're going to be redundant several years down the line. Because like it's a very competitive business, the video game industry, with like the giants of like Activision Blizzard or Microsoft or Sony or like even Tencent, with like their absolutely amazing games like League of Legends or Valorant, which has really been taking the market by storm. There's just so much competition for Ubisoft, and even though I think Ubisoft very much found their niche in like the open world category, they still have to keep on producing if they actually want to maintain that lead. So looking at the numbers right next to it, this is all the money that they have to put into research and development to buy additional studios, to develop additional games, or just to actually acquire studios. This is all the money that they need to produce new titles every single year. So what I'm going to do here is I'm going to do a quick snap into the future, and I'm going to add these numbers in. Okay, and we're back. So what I did now is I added the research and development costs to the already existing capex that it takes to keep running their offices and keep running their services. And what we see now is that the picture is very much changed. So what we see here, actually, when we look at their free cash flow, we can see that many years they have a negative free cash flow, because they're spending more money on developing additional titles and additional games than they are getting from selling their current catalog of games. And I think this is very much the risky thing with a business like a video game producer, is that they have a lot of costs to keep on producing these new titles. And I think this is why, especially lately, Ubisoft has fallen out of favor, because with the potential economic headwinds coming up and the additional interest rates increasing, so debt is becoming more difficult and more pricey to borrow, a growth company like Ubisoft that basically invests all of their free cash flow into additional research and development is a bit more on shaky grounds than, let's say, for example, the waste management business or the grocery stores or any of those like solid businesses that have a very positive cash flow and have a low debt level. I don't actually need to invest that much to keep on growing their business. But that is not the case for Ubisoft. They very much have to keep investing a large sums of money. So the free cash flow, as we can see, sometimes it's positive. Most of the time, it's actually kind of negative. So yeah, take that free cash flow with a grain of salt. Looking at their shares as well, what we can see here is very much the picture of Ubisoft going for growth. They are diluting their share count. They are selling shares to the open market to try and raise additional funds to keep on funding their research and development of their newest titles and the newest studios. Looking at free cash flow per share, it's very difficult to draw any kind of number from this because it's kind of going all over the place, really. Sometimes they are very positive, sometimes it's very much in the minus. So yeah, it's very difficult for me to draw any kind of conclusion of this. Looking at the price per share, in 2012 it was 7.90 per share. It's gone all the way up to 78 euros and 84 cents back in 2020. Massive. In 2021 it was 43. And if I look on the market right now, it's actually become quite a lot lower than this, but we'll get to that in a little bit. Looking at the free cash flow yield, again, it's very tricky to actually work with this because of their fluctuating free cash flow. But on average, it's always ranging around the, well, close to the zero range. But I think, honest to God, it's very tricky. I don't know, it's very difficult to say. I think the 4% is probably the number that we want to be looking at here to give a conservative estimate. But it's very difficult to forecast a business like this when it comes to free cash flow. So anyway, let's have a look at some projections. So the enterprise value model here, their earnings have been very steadily growing, as we can see, for the past 10 years. So this is a very positive thing for this business, and it's a bit easier to forecast than the free cash flow, which seems to be more fluctuating back and forth based on how much they need to invest into research and development. So the earnings have been steadily growing at 10.2%. I'm going to give them the benefit of the doubt here, because I actually do think, because they are investing so much into R&D, I do expect their revenues and their earnings to grow, although I do not expect them to actually reach the 10%. So I'm going to give them 8% for the upcoming 5 years, and after that I'm going to give them a growth of 6%, which I think is relatively conservative when it comes to their earnings forecast. They can definitely make a lot more than this, but whenever I make a forecast, I want it to be as conservative as possible, and when my conservative estimate beats the stock market, that's when I'm going to be interested. So looking at a market multiple, we can see that historically it's been kind of all over the place. It was really up on the moon here in 2020 at 17 times, which I think is very overvalued. And now it's come down to 5.8%. I'm going to go ahead and say that I think around the 5 to 4 times range is probably an accurate conservative estimate for a company like this that is still very steadily growing their earnings. I'm going to be conservative though. I'm going to give them a 4 times multiple. So with their enterprise value, that gives them an enterprise value 10 years from now of 8 billion, to which we subtract the debt and the cash, gives us a market cap of 7.5 billion, which is the value on the open market. We divide that by the amount of shares, and this is assuming that they will not dilute the shares, which I don't think is true, but we've already given them a conservative market multiple as well as a conservative EBITDA growth. So I'm going to assume that this stays constant, just to kind of cancel that out, and that gives me a stock price 10 years from now of 59 euros and 43 cents. Looking at the free cash flow, this is going to be a lot more tricky. So actually, it's taking the very last number and adding 1% to it, which I don't actually think is fair. I think if we actually give them like a reasonable cash flow, where there's not too much R&D investment, like for example 2021, where they borrowed a lot of money, right? So they're using that money as well to invest into R&D. I'm going to say that I think their free cash flow will probably be 0 for the upcoming few years. And after that, I think after about 3 years, after they've heavily invested into establishing a proper cash flow, I think it's going to be going towards these levels of around, let's say around 1.7 and we grow it from there. And I actually think we're going to grow it a bit more lucrative than this. So on average, their free cash flow, I think, is going to grow relatively in line with their earnings. So I'm going to give them 8%. 8% here for the first few years, and drop it down to 6 for the final 2. And this is an absolute complete guess, okay? This is a complete guess. I have no idea what's going to happen because their cash flow has been so shaky. I'm not exactly sure what's going to happen, but I'm going to assume that their free cash flow is going to be neutral or negative, kind of bouncing around that range for the additional few years while they try to establish a proper foothold in their business. And afterwards, I think we can probably expect some reward as a shareholder from holding this stock. Free cash flow yield, like I mentioned, I think on average, I think 4% is probably a reasonable number to give them, which is relatively conservative, although not too conservative. I really don't think it is. So maybe it's actually a bit higher. If you really want to take a very conservative estimate, I think 6% is probably more likely. So I think I'm going to go ahead and go with that just to really get that conservatism in there. So right now on the market, I can buy as many shares as I want of Ubisoft for 18 euros and 93 cents, which has come down so much from their historic numbers. So we can see the last time the price was around this range was 2014. Now it's moved up a lot in the time in between that, reaching all the way to 78. It was 43 last year. Right now it's even halved from that point. It's 18 euros and 93 cents. So I think actually there is some value to be had here, but it's very dependent on exactly where they'll be going with the research and development costs, how much they need to continue to invest into their business to actually try and grow their numbers, because we are giving them an earnings growth, and in order for them to actually reach the earnings growth, they do need to invest in research and development the way they have been doing in the past. So exactly where that's going to end up, I'm not sure. This is my estimate for what I think is going to happen, but this is it's anyone's guess really. So this gives me an enterprise value multiple because I know that earnings will be growing steadily, so I'm going to give them a higher share price when it comes to that of 59 euros and 43 cents. Their free cash flow is more shaky, and because it's more shaky and I'm not sure what to expect, I'm going to estimate that quite low at 27 euros and 78 cents. I cut the both to the middle because I'm not sure which one is going to be right. I'm not sure which one is true. On average, I think there will be a share price of 43 euros and 60 cents out 10 years from now. So that gives us a compounding annual growth rate just when it comes to their share price in 10 years of 8.7% annually. But when I include the cash flow, and this is based on the presumption that they do have a positive cash flow 4 years from now in 2025, I'm not sure that that's true. We're gonna have to find out, but I'm assuming it is. And if it is true, then I expect an IRR, an internal rate of return, of 13.1% if you buy the stock right now and simply hold it for a decade. Now, I always say on average the stock market returns about 10%. And when it comes to that, I think Ubisoft might beat the overall market, but this is very much predicated on the riskiness of their free cash flow, right? So like the moment that this is actually very positive right off the bat, their stock price is going to be increasing a lot. So yeah, if you think Ubisoft is going to be cash flow positive very soon, and these numbers are a lot higher than this, and they can really save on their cost of development, I think there's a very interesting opportunity to be had here. But if they still have problems finding a proper way to create a free cash flow, I think it's a very risky business. And I think it's a very risky business for me to get a payback of potential 13.1%. The stock price has come down a lot because I think that's only fair, because they seem very overvalued previously. And I think the share price very much reflected that, the drop in share price, that is, to a more reasonable level. So I think Ubisoft is a risky investment, but it can give amazing returns if it turns out right for Ubisoft. But it's very much depending on what the video game industry as a whole is going to be doing in the future, and just how well Ubisoft is able to capitalize on their R&D and their establishment of free cash flow. So yeah, that was Ubisoft, a very risky investment, but maybe it's definitely worth a shot for people who are a bit more risk tolerant than I am. So thank you very much for watching. Don't forget to like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio!